and the markets did move on it. Joining me right now is the Bear Traps Report founder and editor, Larry McDonald. Larry, it's great to see you. Thanks very much for being here. I'm trying to understand what just happened with these markets, Larry. I know you say the surface of the U.S. labor market looks good, but underneath we're experiencing some of the most disturbing data we've seen in years. Why do you think this jobless number moved markets so significantly this morning?
Well, we're in the bad news is good news stage now, because anything that comes out in terms of negative numbers will basically give the doves on the Fed more power to do the Michael Jackson walk back, the moonwalk back. I think that's what's happening now with jobs.
I see. And your thoughts on this market? We're waiting on the consumer price index out tomorrow morning, 8:30 a.m. Eastern. Yields are up 3.5 basis points this morning, with the 10-year at 3.057%. And we're expecting inflation to be holding steady at 8.3%, same number as April. But, of course, this is going to be important to the Federal Reserve ahead of the June FOMC meeting next week, Larry. What are you hearing from all the institutions that you're in touch with in terms of what the Fed's going to do, in terms of raising interest rates next week, and this inflation data?
Well, thank you for that, Maria. We run a live conversation with about 650 institutional investors in 30 countries, so buy-side hedge funds, mutual funds, pension funds. In the last 10 days, the conversation in the chat has been pretty disturbing around explosive rescindings. In other words, if you're a young person in the Valley that works for any one of these private or public tech companies, we're seeing the largest explosion in rescinding job offers, that we've seen since the dot-com bust. And this is a phenomenal leading indicator for jobs. We think, in the Bear Traps Report, we think the jobs by September go into the negative column in terms of the non-farm payrolls. I mean, we're just an explosive kind of pullback in job creation, and also that's going to lead to job cuts.
This is such an important point that you're making, Larry, in terms of what you're hearing from your chat, your institutional chat. You're talking about layoffs in an environment where we're supposed to be actually seeing growth. We had a contraction last quarter. Now, we heard from the European Central Bank this morning. They left interest rates unchanged. That's rates at negative 0.5%. They are planning on raising interest rates to get to zero, and they're going to do away with their quantitative easing beginning on July 1. Markets worsened there in Europe after the ECB meeting. Larry, was that the right move? And what about the Federal Reserve? Is that going to help in terms of raising interest rates in a slowdown, Larry?
Yes.
You're talking about job cuts. The Fed is making things harder and more expensive, raising rates into this slowdown.
Yes. You know, when you don't allow the business cycle to function over longer and longer and longer periods of time, and you don't allow price discovery. So the Fed essentially, for the last 24 months, Maria, the Fed has not allowed price discovery in the market. So we're talking about on loans, on high-yield bonds, on any kind of financial instrument. Because they were doing so much accommodation for so long, there was massive distortion of the asset prices. And now, because of inflation, they've been forced to really machine gun price discovery at us, right? So this is a colossal failure of common sense, because I think that we're really heading for a Lehman-type moment in here, because I think, in listening to institutional investors, the marks on private equity and venture capital are potentially off by $600 billion. And I think so we have this Lehman problem lurking. That's why the market, when it rallies the last couple of months, you and I were talking about this in January, we were calling for a 30% pullback. Every rally's failed because there's really a beast, there's a serpent underneath the surface of the market that is yet to rear its ugly head.
Yeah, you were so right on that 30% sell-off. That's exactly what we got. The NASDAQ is still down 22%, and yet Exxon stock is hitting a record high yesterday, first record in 8 years. The oil giant stock closing at 104.59 yesterday. The stock is up nearly 71% year to date. And you've got money moving into energy overall. The whole sector's up 60 to 70% year to date. Big tech, meanwhile, facing the biggest rout in over a decade, having its worst start to any year since 2002, Larry. And I know that Alibaba, Peloton, Microsoft, Apple, Meta, all planning layoffs to speak to what you just said. But I want to get back to something you said. You said we are looking at a Lehman Brothers moment. What does that mean?
Well, you know, when you don't allow price discovery for so long and then you force price discovery into the market, what happens is in the private equity space, we're seeing some very disturbing letters that have come out. D1 sent a letter to clients on Friday. It was widely reported. But the marks on the street between your public marks on public assets and your private marks, that's the conversation that I'm hearing from institutional investors. This is the widest divergence that we've seen. So under the surface, we're talking about $500 billion of losses on assets that are mismarked. And if the Fed stays on this path, this aggressive path, they're going to basically break something very soon. And so they're going to be forced to reverse. So this year, we could have a big rally toward the end of the year. Right now, we like China equities, FXI, KWEB. KWEB this year is flat, which is China tech, versus the NASDAQ. Most NASDAQ names are off 30%. So there are some bright spots on the planet.
So you think you're going to see a year-end rally, but how bad can it get before that? I mean, are you in the camp of Jamie Dimon with an economic hurricane on the way?
Exactly. Like think of Elon Musk and Jamie, right? Jamie had these comments 3 weeks ago. They were really rosy about the economy, and then he flipped. And I think I've been watching your program. You've been making note of that. But even more disturbing, Elon Musk has the best Rolodex on the street. The guy can literally pick up the phone, make 5 phone calls, and raise, you know, $25 billion. Like, he has the best Rolodex in the private equity, venture capital space, bar none. And something that Musk is seeing under the surface, from our contacts in the Valley that are close with him, they said he's really scared. That's why he's done this 10% layoff. He sees something, I think he's talking to the VC people, and I think he sees this mismarking problem.
Yeah, he said, I see a super bad feeling about the economy right now. Larry, it's great to catch up with you. Thanks so much. Really important points that you made this morning. We appreciate it.
Great to be back in the studio.
Yes, Larry McDonald joining us. We'll see you soon, Larry. Thank you for coming in. Quick break and then wrap.